Hello everyone, and thanks for watching the Market Report. This is Marcel Pechman, analyst and writer at Cointelegraph. This show debates the most pressing topics impacting the crypto market, and it airs every Tuesday, exclusively on the Cointelegraph Markets and Research YouTube channel. So the biggest news this week was Bitcoin reaching 50% market share dominance. As covered by our friend Tom Mitchell-Hill, BlackRock's spot ETF filling and the Securities and Exchange Commission crackdown on crypto are driving investors toward Bitcoin. This means that Bitcoin alone accounts for half of crypto's total $1.1 trillion market capitalization. Notably, Bitcoin's market dominance has surged by more than 10.5% since November 27, 2022, an increase driven in large part by investors looking to the flagship crypto asset as a safe haven in the wake of the FTX crisis and amid mounting regulatory scrutiny of crypto assets in the United States. Well, first of all, we need to understand how polluted such data is. When analyzing the entire crypto market capitalization, you are accepting the reported data from random altcoins besides double counting Rapid Bitcoin and Staked Ethereum. For instance, supposedly some 40% of the BNB, the third largest cryptocurrency, will never hit the streets. Those coins were reserved to the burn mechanism. That difference on BNB alone creates an additional 11 billion market capitalization. There's also the Lido staked Ether, the wrapped Bitcoin. So you're doing a lot of double counting when considering the total market capitalization. But more importantly, you're adding stablecoins to the number. But how is the growth of traditionally backed US dollar tokens compete with Bitcoin and Ethereum and the crypto industry? It does not relate. Those are dollar-pegged coins. Those are tokens that merely represent a dollar deposited on a US asset, such as a bank or a bond. It's not really a cryptocurrency. So if you exclude stablecoins and you adjust for the BNB, for instance, Bitcoin's dominance stands at 58%, the highest level since April 2021. I'll show the chart on TradingView of the adjusted Bitcoin dominance. So we are excluding stablecoins. We're excluding 40% of BNB as well. So we presently stand at 58%, but it's been as high as 75.5% in the end of 2020 and a low of 42% in May 2021. So if Bitcoin dominance continues to go up, we still have a lot of ground to cover before reaching the numbers we saw by the end of 2020, 75%. So we're midway through the recovery. Now, back to the article. MicroStrategy co-founder and outspoken Bitcoin bull Michael Saylor believes that Bitcoin's market dominance will top 80% in the coming years, as increasing regulatory pressure from the SEC causes stablecoins and the majority of other crypto assets to go away. Now, you might not be a Bitcoin maximalist, but we have to admit that no one expected Bitcoin to become the second largest NFT, non-fungible tokens blockchain. According to CryptoSlam, the 30 days adjusted data, excluding wash trades, for Ethereum was $380 million versus $104 million for Bitcoin and $40 million for Solana. So there's the blockchains by NFT sales volume on CryptoSlam. You can check the 30 days data for Ethereum right here with 185,000 buyers, while Bitcoin captured 46,000 buyers in 30 days with $104 million. So Bitcoin was not designed, nobody expected that, but it became the second largest NFT blockchain. Because of the ordinals and the BRC20, it doesn't matter. It was unexpected and it quickly became the second largest blockchain for NFT markets. Maybe what Michael Saylor is envisioning here is that the decentralized finance, the DeFi industry, will eventually move to the Bitcoin network. Sure, that might sound impossible right now, but that's because there's presently no infrastructure for smart contracts on Bitcoin, not the ones required for DeFi applications, whether or not using a second layer. So it doesn't matter if Ethereum or some rollup is the absolute leader right now, because we're talking about a sector that was born 4 or 5 years ago. So it's brand new. Moreover, the present $42 billion total locked value, the TVL, is totally irrelevant for the broader financial market. If you compare the TVL of DeFi applications to the stock market or to the financial mutual funds industry, we're tiny. It's a drop in the bucket. It's nothing. So it's very incipient. It's the first 4 or 5 years. It still have a long way to go for being developed, and Bitcoin may, in the future, capture some, if not most, of those applications, the TVL. A similar argument could be made for the altcoins in favor of them, because they currently are under the pressure of the SEC regulator. Those teams might be forced to remove listings from the US-based exchanges, stop promoting services to US citizens, and maybe pay a hefty fine. But ultimately, there's nothing the SEC can do to stop a cryptocurrency from being developed, traded on decentralized exchanges, or used by anyone with an internet connection. So my personal view differs from Michael Saylor. I do think that most of the altcoins will survive, whether or not the SEC wants. But for now, it seems that Bitcoin is winning some sort of battle. And that's because those headlines are catchy. 50% dominance. But thinking in a competitive analysis, for example, when Ethereum moved to proof of stake, it became crystal clear that it was not competing for the aspects that make hard money, as its focus, the focus of the Ethereum network, moved to lowering the cost of transaction and adding scalability to process smart contracts. So Bitcoin might be competing with the US dollar and gold as a global store of value, and Ethereum shifted their focus to their global decentralized smart contracts, application, etc. So they can change their monetary aspects every year or every couple of years, while Bitcoin has maintained since inception its monetary policy. It's like comparing the market capitalization of real estate funds or REITs with the Apple and Google. Just because they're both traded on NYSE, they're not direct competitors, period. Just to highlight, that's my own personal opinion. It does not constitute investment advice or reflect Cointelegraph's official view. Now, on to the next topic, we'll cover an article by William Suberg. Bitcoin's price, sideways boredom, may last 18 months. New research. In the latest edition of its weekly newsletter, The Week on Chain, analytics firm Glassnode predicted an arduous period for Bitcoin holders next. With the 2024 block subsidy halving in sight, some believe a dramatic uptick will characterize the coming year, while others think it will take longer, perhaps until 2025, for a new all-time high to hit. For those unfamiliar, the Bitcoin halving, where the block subsidy for miners will be cut by half, is expected for June 2024, so next year. And those halvings historically have been bullish for the 12 or 18 months after the halving, as the coin gets more scarce because there are less coins being issued every day. So the article goes by saying, if we compare this behavior to previous cycles, we can see that this regime of steady and gradual accumulation commenced just 2 years ago and suggests that another 6 to 12 months may be ahead of us. So it says a period of accumulation. You can say that it's similar to range trading. Yes, it's going to move from $26,000 to $30,000, then back to $22,000, but it's going to fluctuate within a range. That's what is called accumulation. But firstly, is there any fundamental backing this assumption? No. CoinGlass is merely using a logarithmic price chart to show that the 2 years ahead of the halving are more quiet than the rest. Let's check the chart shown by CoinGlass here. So what they're basically saying is that you have those long terms of 2.5, almost 3 years of accumulation. Then after the halving, you have those big price rallies. So that's what the article is basically saying. But whenever you use logarithmic scale charts, dramatic 50% price movements tend to disappear when compared to a 400% bull run. That's the secret of their analysis. But in real life, if Bitcoin's price spikes from $25,000 all the way to $70,000, and then it corrects down to $40,000, for example, that's life and death for most traders, at least those using leverage or putting all their chips on a halving bull run. So ultimately, calling the pre-halving period a sideways boredom just because Bitcoin eventually reaches $150,000 or $200,000 after the halving does not make sense. Bitcoin already pumped 60% in 2023, this year alone, in 6 months, and it's melting faces. So stop dreaming about what's going to happen, what may or may not happen in 2 years. On our third and final topic for today, we'll discuss an article written by Prashant. Deutsche Bank reportedly applies for digital asset custody license from BaFin. This comes after a similar shift from the bank's investment arm, DWS Group, and aims to expand on digital asset custody services, including cryptos. DWS had previously indicated an interest in investing in 2 German crypto firms. Okay, but what exactly is a digital asset custody services? That's just holding assets for clients. That's not investing the bank's own money or integrating cryptocurrency services. We've got to make a clear distinction between a tokenized asset, which can represent a real estate investment, stock, bonds, or any financial instrument, and a cryptocurrency. So even if Deutsche and DWS start doing custody of those digital assets for their clients, the banks themselves are not promoting or integrating cryptocurrencies. For example, integration would be accepting Bitcoin and Ethereum deposits as collateral for international shipping operations or for bank loans. And we're very, very far away from this ever happening. Again, that's exclusively my own opinion, which might not necessarily reflect Cointelegraph's official view. Well, that's it for today. I hope you enjoyed the show. Don't forget to visit Markets Pro, the Cointelegraph professional alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!